Oh, okay. I see what I did wrong. There you go. Good luck reading it. Sorry about that. I'm either a doctor or a serial killer. One way or another, my writing is terrible. Okay. So we've been talking about the mortgage payment of principal and interest, but that is commonly not enough. It's not all. Principal and interest is going to satisfy the lender, but you also have to pay other entities too. You got to pay the taxes and you have to pay the insurance. And the lender cares about those too. Because if you don't pay the taxes, the taxing authority can foreclose on your property and the lender's out. The lender's down the list from the taxing authority, right? And then if you don't pay the insurance and the house burns down, the lender's collateral burned down. So the lender cares a lot that you pay all of these things, not just their principal and interest. Well, their interest. So you're paying the principal because you want to pay the loan amount down. You're paying the interest because the lender requires it for the privilege of borrowing the money, and you're paying the taxes so they don't foreclose, and you're paying the insurance so it's protected. The principal and interest portion is called the loan payment. The taxes and insurance are known as the escrow payment. Because typically your mortgage payment includes all four of these things known as PITI, pity payment, PITI, principal, interest, taxes, and insurance. And all of that together is what you're paying per month. What could change from year to year out of this list of four things? What could change from year 1 versus year 5? Or let's say more strategically, year 4 or year 8? Yeah, that tax amount could go up because your taxes were reassessed. And so the lender's going to say, they'll send you a notice and say, hey, the taxes got reassessed. Now your tax bill is higher. Now we need to adjust your escrow payment. And now your monthly payment, the tax portion is increasing by $100 a month. So we want you to send that amount in instead of the previous amount since you're paying a PITI payment. And the insurance may or may not adjust. It just depends on the coverage, right? It depends on your choice of coverage too. Maybe because you wanted more coverage, your insurance amount went up, so you have to adjust that accordingly. Why might your insurance go up? Maybe you get married, you buy a ring, you want that ring covered, and so you have to add that into the insurance policy. Or maybe you buy another motorcycle or a guitar or a car or whatever. So those things can change, but what won't change is the total of principal plus interest, because that's your monthly payment. And as long as it's a fixed rate, fully amortized loan, that amount is going to be consistent. So just be aware of this sort of skeleton here, how this works, PITI, and what that stands for. Because we're going to have to calculate the escrow payments later. Taxes and insurance. How much will your monthly taxes be, by the way? I'm not looking for an exact dollar amount, but if you know your annual taxes, how much are your monthly taxes? It's as easy as that, right? You already know how to calculate your annual taxes. We've done it. So you'll just divide it by 12. And that's what this is. It's 1/12 of your annual tax bill added on to the principal and interest. And then the insurance, whatever your annual insurance premium is, divided by 12. That's all we're doing here. It could be, you might have heard of some people who don't want to escrow their taxes and insurance into their payment. They like to pay it when it's due in full. And that's allowed. The lender can let you do that. The lender would prefer that you do it this way, though, especially if you're a newer buyer, first-time buyer, because they want you to get used to it and make sure that you don't forget to pay these things. At least if it's set up like this, the money is in their possession, and they'll send those bills in when they're due, and they know they got sent in. Because by making a PITI payment, why it's called an escrow payment, that lender has set aside an escrow account, set up an escrow account where they're collecting 1/12 of taxes every month, 1/12 of insurance every month, and it's accumulating. And then when it comes due later in the year, the money is there, and they're going to send that. They're not sending 1/12 every month to the government. They're waiting for it to accumulate and to get to the point where it comes due in the year, and then they'll send the full amount paid in full. So what you're going to have to do in Chapter 21 in closing math is the lender, to set up the loan and to go to closing, the lender's going to require a certain number of months of taxes to be collected up front and a certain number of months of insurance payments, because the lender wants to make sure there's a little bit of cushion in those accounts. They can't just go crazy and collect 80 years of insurance cushion. They would love to if they were allowed to, but it's illegal. They have certain maximums they're allowed to collect up front for escrow, and they'll set up your new escrow account with maybe 4 months of taxes and 8 months of insurance. It depends on their preferences and the time of year you're closing. The lender will tell the attorney how much to collect from the borrower to set up these escrow amounts. And then every month you're paying into that 1/12, 1/12, 1/12. And then the money's available as needed. Okay. How we doing? It is nice not to have to worry about that extra payment, you bet. Some people are just really responsible and they're just very controlling about it, and they just like to do it themselves, or especially once it's paid off. I mean, there is no lender and they have to do it themselves then too. So if they've already experienced that in their lives, then they come back to a mortgage payment, they might not want to give up the paying of the taxes and insurance on their own. But good classic standard advice to give your client that PITI is probably the way to go, just to be safe. And the lender is probably going to require them to start out that way, but then maybe give them a choice to stop and pay it themselves if they want to. Okay. Now, let's talk about what a lender is thinking. What if you were loaning somebody $100,000? What questions would you ask them? It's fair game, by the way, to ask them about their money, because they're asking you to borrow $100,000 of your dollars. And so you have every reason in the world to find out some info about their financial situation. What do you want to know? You want to know that they can pay you back as agreed upon. And so what sort of thing to be sure they can pay you back are you going to ask? Especially if it's that cousin of yours that everybody knows is sort of a dreamer, not so much a doer. And you're like, wait a minute. You only ever do what feels good, and you've never had a real job, and you want to borrow $800,000 of my money. How much do you make every month anyway? And that's well within your rights to ask them, what do you make every month? Would you want your cousin that you're going to loan this money to, if they made $10,000 a month, would it bother you and affect your decision to loan them the money if you found out that their bills added up to $9,800 a month already? Car payment, the other car payment, the motorcycle, the other motorcycle, the new guitar once a month, the spa, the bars, the lottery tickets, the cigarettes. Every month they blow $9,800 of their total $10,000 that they bring in. It's great that they make $10,000, but it's not about what you make, it's about what you keep. So this lender wants to know, what percentage of your monthly income are you going to have available to spend on the house payment? And the lender does not want a borrower to spend more than 28% of their monthly income on principal and interest, taxes, and insurance. They feel like if you're spending more than 28% of what you make every month on PITI, you're more likely to enter into a bad situation and maybe go into foreclosure. And again, that lender doesn't want to foreclose. It's expensive and time consuming. They're in the money business, not the real estate business. They don't want to own real estate. They have to sometimes because they had to take the house back in foreclosure. But that's what this qualifying the buyer is about. It's called debt to income ratios. And the ratio for a conventional home loan that we'll learn later shortly tonight, what is a conventional loan versus VA versus FHA. To get a conventional loan, the lender requires that no more than 28% of your monthly gross income goes toward the PITI payment. That makes sense. And in a perfect world, that's all that they'd need to care about. But here's the other thing. That cousin of yours has 2 motorcycles and 3 cars, and credit card debt and student loan debt. And guess what? It's not just about the house payment, it's about all those other bills too. And that's the lender's business also, because that affects the chances of your cousin repaying the loan. And so PITI plus the car payments, plus the credit cards, plus any other recurring monthly debt cannot exceed 36% of the gross monthly income if you're borrowing a conventional loan. Again, this is dependent on the type of loan. This 36% is called the back end ratio. The 28 is called the front end ratio. So back end ratio is a much more realistic number. Front end is all well and good, but it doesn't take into account the person's lifestyle choices. And they're spending an additional $1,300 a month plus the PITI payment that they're going to have if you sell this house and loan them the money to do so, if they buy that house. So the back end ratio for a conventional loan typically is 36% maximum. Lender doesn't want them to pay more than 36% of their gross monthly income toward every recurring monthly debt plus the PITI, all combined. By the way, on an FHA loan, that back end percentage is 41%. So they're helping, remember FHA, VA, they're helping somebody accomplish their home ownership dreams. And so it allows somebody who has more monthly debt, maybe because they have medical bills and student loans, and a very good reason. Like, it's not just that they're a consumer, they have good reason. So it lets them have a chance. They're going to be disqualified from borrowing a conventional loan because they exceed the 36% max back end ratio, but they still are maybe only 40% on the back end because of their various monthly obligations. So that'd be what the lender, the loan originator, loan officer that you hook them up with, they're going to say, "Oh, sorry, you gave me all of your expenses, and it looks like you're adding up to 40% per month of your gross income, so we can't do a conventional loan for you. Let me explore the FHA option." And that's kind of how that works. By the way, in real life, even if your borrower can qualify for FHA or VA loans, it's probably smarter to at least try qualifying for a conventional loan first, because they tend to be cheaper in terms of the various fees, how much it costs to make a conventional loan. Because again, that's for the best credit borrower, the most down payment borrower, but definitely the better credit profile. It's when you don't have as much available for down payment, because FHA loans require at least 3.5% down payment, while a conventional loan typically requires at least 5% or more. There are exceptions, but those are going to be based on higher credit scores. But for your purposes, conventional starts at 5% down or more, FHA as low as 3.5% down. VA all the way down to 0 down payment. Yeah, you can borrow the full loan amount, the full purchase price. There are more fees, though. There's fees involved. For the privilege of a VA loan. But you might get a lower interest rate since you're a veteran, and that's, again, giving them a benefit because of their service. But back to this qualifying math. The two ratios, the front end ratio, 28%, just PITI. The back end ratio, PITI plus everything else. So how does this apply to some math? If we have a principal, interest, taxes, and insurance payment, how are we going to know, what that PITI payment is? Well, based on the house you want to buy. The house you want to buy is, let's say, $200,000. You're going to borrow $180,000 times whatever the interest rate is, plus whatever the taxes are and insurance are per month estimated. All of that adds up to a monthly payment of $1,500. You're going to figure that out with the loan factor chart, or in real life, like a loan calculator or the lender themselves. You're going to say, oh, for this $200,000 house, with the place where it's located and the taxes they charge and the insurance because of the house itself, our payment is $1,500. Our question is, how much do we need to make per month to afford a $1,500 payment and qualify on that front end ratio of 28%? So in other words, $1,500, this is going to sound familiar to you. $1,500 a month is 28% of what? Have you heard that before? That's our little trick formula that we created back when we did seller net math. And I think we also did it with commission. So $1,500, because you know the payment, principal, interest, tax, insurance, divided by the front end ratio, 28%, means that you need to make at least $5,357 in order to qualify for this $1,500 PITI. Another way to word it, $1,500 is 28% of $5,357. But that's not enough. We got to check. How much do you make? Oh, I make $5,500 a month. Great. So you qualify under the front end ratio because you only need $5,357 and you make $55. But that's not enough. We need to see if you qualify under the back end ratio too. And so when we do that math and we go over here and realize, oh, your monthly payment, $1,500, that's what your house payment's going to be, but you have some extra monthly expenses of $700 more per month. Car payment, student loans, credit cards. By the way, could you get rid of some of that maybe? Maybe you just bought the Lexus and it's a $600 payment. Maybe you could turn that back in or sell it or get rid of it somehow and have a regular car payment of $200 instead of $600. And now you just gave yourself $400 of wiggle room here. So that's another thing that borrowers and lenders are talking about. Hey, I'm really close to qualifying. What can I do with my finances to fix this? Oh, $300 a month is going toward credit cards. Maybe mom and dad will give me enough to pay off those credit cards so I don't have that recurring credit card amount. So they start doing some acrobatics now that they have an incentive of home ownership to go by. Okay. PITI plus the extra recurring debt is a total monthly expenses of $2,200. If you buy this house with that payment plus the debt you've got per month, you're going to have to pay $2,200 a month. So you need to make sure that no more than 36% of your monthly income is going toward that $2,200. So the same thing, $2,200 is 36% of what number? If you do that math, then you need to make at least $6,111 in order for $2,200 a month to be 36% of that. And if you remember, I said that we make $5,500 a month. Bad news. We qualify under the front end ratio, but not quite under the back end ratio. We would need this to be 55 or less, but it's not. How far off are we? 500 plus 111, $611 off. So we need to get rid of all but $89 of this monthly recurring, wouldn't we? Maybe we could pay off that car. Maybe grandma dies. It gives us a chunk of money. We could pay off our car payment. We can get rid of the credit cards, not make any new ones, pay off the student loans. And now we don't have this $700 anymore. Now $1,500 is the PITI, and it's also the total because we have no, that's probably unrealistic, but you just get my point, right? What if that were the case? Let's just say we got the expenses down to $600 or $100 a month instead of $7. Then 15 plus 1 is 1,600. And if we do 1,600, I'm doing this here, divided by 36%, that would mean that we would need to make, wait a minute. Yep. Let me do it one more time. 1,600 divided by 36, $4,444 a month could be our gross monthly income. And so we would qualify under both because we make 55, right? So that's the magic of the recurring monthly debt. Get rid of it and you don't have that problem. You can qualify again. So that's what you could see on the test. Just be aware of how to manipulate this back and forth $1,500 is 28% of what amount? And on the test, they'll say your monthly income, your gross income is $4,700. If that's the case, do you qualify to buy this home? If what you make per month is $4,700? No, because you would need 53. You're $657 short. And same thing for the back end ratio. Oh, wow. Blew past that break, I think, right? Oh, your break. Is that right? We've been at this for a bit. Okay. Let's come back in 10 and we'll just keep on marching on through some math. Welcome back. Okay. Let's take a look at another problem. Actually, let's look at these first. Let's look at those. Let's get good on this qualifying ratios while we're thinking about it. 1 second. Oh, sorry. Okay. So hopefully you can see that okay. A buyer is discussing obtaining a loan with their preferred lender. During the qualification process, the buyer learns that in order to get the loan, they must have sufficient income to meet the debt to income ratios of 28% and 36%. Their current income per month is $15,000. Using the above information, what's the maximum amount the buyer could pay for monthly principal, interest, taxes, and insurance? So if current income is $15,000 per month and the front end ratio, which is the one that covers principal, interest, taxes, and insurance, is 28%, then how many dollars is 28% of $15,000? Just multiplying those two things together, right? 15,000 times 28%, and there it is, $4,200. So number one, A, $4,200 is the maximum amount the buyer could pay for monthly principal, interest, taxes, and insurance. What's the maximum amount they could pay for total monthly expenses? 15,000 per month times 36%. So the most they could pay for PITI plus whatever their recurring debts are, $5,400. And so then the third question, how much, based on these numbers, could their monthly recurring debts be? In other words, how much more than $4,200 is $5,400? Because their back-end ratio, 36, total monthly expenses is $5,400 minus the 42. That means no more than $1,200 per month could go toward whatever those extra expenses are. Car payment, credit cards, things like that. Student loans, recurring monthly debt. Right? That good? Buyers qualifying for a new loan using debt-to-income ratios of 28-36. If the buyer will have annual property taxes of $3,600, homeowners insurance of $1,200, their current monthly recurring debts are a student loan per month of $400, credit cards of $500 a month, car payment of $350 per month. The buyer has a $120,000 annual income. How much is left for principal and interest payments? Oh boy. A lot of numbers flying around here. Let's take it a step at a time. If their annual property taxes are $3,600, how much are they per month? We're looking for how much their PITI is going to be. So how much would the T need to be per month? if annual property taxes are $3,600, $3,600 divided by 12. So $300 a month for taxes. What about insurance? If it's $1,200 per year, what is it per month? $100. So just $300 for taxes and $100 for insurance. $400 for the T and the I. Let's just kind of set that number off to the side. Their current monthly recurring debts add up to what? Student loan for $400, credit cards for $5, that's $900. Car payment for another $350, that's $1,250. So $1,250 for the recurring debts, $400 for the taxes and insurance. And then we also know that they have $120,000 of annual income. What does that mean per month? $120,000 per year. Divide by 12. $10,000 a month. And so if they need to qualify for a front-end ratio of 28% and they're making $10,000 a month, what's the most their PITI can be with those numbers? 28% of $10,000. That's $2,800. So $2,800 is going to be what they're paying, the maximum they can pay for principal, interest, taxes, and insurance. Let's look at it with some numbers here. $2,800 is the 28% of $10,000 per month. $3,600 is the 36% of $10,000 per month. But out of that $2,800, how much are they spending for taxes and insurance? $400, right? We did that because we knew how much the annual taxes and insurance were. 28 minus 4 is $2,400. And then their total recurring debt is $1,250. So the amount left for principal and interest payments is $1,950. If we take $1,950 wow, I can't do calculator today. Our principal and interest is $1,950. Our taxes and insurance is $400 combined. That's $2,350 for all of that. Is that less than the 28% of the front end ratio? So they qualify under the front end ratio because they needed 28. They could spend no more than 28, and all they're spending is $2,350. And then the back end is still safe too. They're covered. I'm going to give you a couple. The RD, the $1,250 is the recurring monthly expenses of the loan, the credit cards, and the car payment all added up together. And so that $1,250 plus the $400 for taxes and insurance plus the $1,950 for the principal and interest adds up to that $3,600 back end ratio. In other words, we took the $3,600 because we knew that the most they could pay for everything combined was $3,600 at 36% of $10,000, right? $3,600 minus the $400 for taxes and insurance per month minus the $1,250 for all those recurring debts is how we got to the $1,950. Let me walk you through it on this thing. That might be distracting to see all those numbers clumped all together. So in this case, we knew that their annual income was $120,000 a year. Divide that by 12 months. That means a $10,000 per month income. We were also told that the annual property taxes, PITI, so the T was $3,600 per year. Divide that by 12 means $300 is going toward taxes per month. And then $1,200 for insurance divided by 12 means another $100 is going toward insurance per month. So those two together are $400. I'm just making an inventory, just a list of all the expenses right now. And then the recurring debts are student loan for $400 plus credit cards for $500. Let me do it this way. Plus car payment for $350. And all of these add up to $1,250. So every month you got to pay the $1,250 for all those things, plus the $400 for the taxes and insurance. And so all that adds up to what, $1,650? Now, what's left? We got to figure out the principal and interest. So how much is the most we could spend toward principal and interest? That's going to depend upon those ratios, the 28% and 36% ratios. And so 28% of the $10,000 per month is $2,800. Easy math. 28% of the back end, 36% is $3,600. And so if $1,650 is what you're spending for taxes, insurance, and all those other car payments and this and that and the other, and $3,600 is how much the most you're allowed to pay for everything combined based on the income, then just do that subtraction. 3,600 minus 1,650 is $1,950 that's available for the principal and interest. Does it make more sense seeing it that way? It's intimidating. I know. It's like, oh, wait, these numbers are just flying all over the place. But the idea here is you're just comparing the ratios with what the expenses are. Like how much is that monthly income and what percentage of that monthly income can go toward PITI and then PITI plus everything. Screen cap that for you, if that's helpful without catching my face. Let's see here. Is that possible? Oh, let me move over. Okay, there we go. There you go. There's that. Let me see. To kind of recap various maths that we've accomplished, you won't see a problem like this, but this problem is like a whole bunch of math all packed into one. So from this one, you'll see any of these any of these possible answers or questions that they're asking. They might ask, what's the commission amount? And so based on, I don't think they would give you quite this much detail, but the buyer's buying it for $425,000. They're going to use a conventional loan with a 90% LTV at a 4.5% rate. It's just got all the stuff in there. What do you need to know to calculate how much the commission is going to be? You need to know, make a separate sheet of paper and write this sort of thing. Commission problem. I need the price and the commission rate. Tax value problem. I need the tax rate and the assessed value. Annual taxes, same thing. They're kind of combined. Loan amount. I need the purchase price and the LTV. loan to value ratio. Annual interest, I need the similar to taxes, right? I need the interest rate and the amount being borrowed. The loan amount times the interest rate gives us the annual interest. Origination fee, I need the percent that it cost multiplied by the multiplied by the loan amount. And then discount points, same thing, the percent they cost multiplied by the loan amount. And then loan balance after the first payment. I need stuff from the loan factor chart to get the monthly payment, and I also need to use the annual interest in dollars to get the monthly interest in dollars. So review kind of and keep notes of what you need to accomplish these things. So commission, the commission payable, here it is, 5.5%. What's the price? Oh, purchasing for $425. What's 5.5% of $425? There it is. The commission, if number one is what's being asked out of this problem, commission is $23,375 total. If tax value is what's being asked, what do you need from that? You need to know what percent of the market value is the assessed value, and that is right up here, 75%. 14 mils based on 75% of market value. So 75% of 425 is a tax value of $318,750. Annual taxes, take that $318,750 and multiply it by the 14 mils and then divide by 1,000 because you needed to convert the mils to decimal. And that gives us the $4,462.50. Going through this fast, but we've done all of this before. Loan amount is just the LTV of 90% times the price of $425. 90% of $425 is a loan amount of $382.5. Annual interest is going to be the loan amount times the interest rate. Interest rate is 4.5% times the loan amount of what we figured earlier, $382.5, is annually $17,212.50. And then number 6, total origination fee is going to be, what are they charging? Looks like 1% origination fee. 1% of the loan amount means, okay, here's a way they might ask for origination fee and discount points. They might ask for it all together. The problem might say they're charging 1% origination and 3 discount points. So you're going to have to think, what's the total dollars spent toward all of that combined? Well, in this case, the origination fee is 1% of the loan. The discount points are 3, so 3% of the loan. And instead of calculating 3% of the loan and adding it to 1% of the loan, just say 3 plus 1 is a total of 4% of the loan. And so 4% of the loan amount is combined discount plus origination fee, $15,300. And then we won't dig too deep into this because we just did it tonight, but the loan balance after the first payment, calculating the monthly payment, calculating the monthly interest, subtracting to find out that you only paid the principal down by $505 and subtracting that from that loan amount. So this is in the slides. In fact, I'll just screen cap that too so you'll have it close at hand. You can maybe be a little quicker. There we go. You're welcome. There it is. Okay. Now let's get into the secondary mortgage market. This is getting into chapter 15. Secondary mortgage market is the marketplace where the loans are getting bought and sold from lender to lender. So when you got your loan to buy that house, that's one loan. One loan with a borrower with a certain credit score and a certain level of risk. What lowers the risk? Meaning the risk to the lender of getting paid back the money that they loaned to you. what lowers the risk is a higher credit score for the borrower because they've proven that they're more willing to pay back loans in their past, and also how much they've borrowed. The less they've borrowed, or like Victor says, the more down payment, the more equity they are subject to lose if they let the property go into foreclosure, right? So if you put down 50% as a down payment, that's a lot of your own money that you stand to possibly lose if you let it go into foreclosure. You're probably going to keep making your house payment, even if you have to let the cars go. If you had to make a choice, subject to maybe losing that much money, you're probably going to make it a priority to keep making that house payment. Compared to if you were only borrowing 97 or 96.5%. If you were only putting down 3.5%. So let's say it's a $500,000 house and you are borrowing 96.5% of that. You're borrowing $482,500. You've put down $17,500 as a down payment, because that's 3.5% of 500,000. What if you put 50% down? That's $250,000 as a down payment. Not a lot of people have that. Not a lot of people put 50% down. But I'll bet the borrower who put $17,000 is more likely to let the loan go into foreclosure than the one who put $250,000 of their own money in it. And so that lowers the risk to the lender. They're happy with a borrower that's putting that kind of a down payment, borrowing that much less than the asking price or the contract price. So the lender is going to lump together all of your loans like yours with those low risk loans, higher credit score borrowers together, because they're more predictable, that they're all equally of the same lower risk. The lender's pretty sure they're getting their money back. Makes them more valuable. Wouldn't you like to buy a loan from somebody knowing that that borrower is much more likely to pay you back? So you're buying these big chunks of loans of similar risk. And that's what's happening on the secondary mortgage market. All those individuals who got individual house loans are lumped in together, and that's all of them are getting notices in the mail next week that their payment is now going to have to go to X such and such new lender, right? Because that lender bought their loan. Why would a bank buy a loan? Or a whole batch of loans. Why would a bank do that? Because they want the long-term income. A bank says, I've got a chunk of money and got several $1 million, but what I want is a bunch of people having to pay me interest every month for the next 30 years. So that lender is choosing to have long-term income for various reasons. Why would a bank want to sell off and get rid of their long-term income and say, let me batch all these up and sell them to somebody else so they can get a big influx of cash and make a profit on it, by the way, right? Because they're selling a pretty valuable product in the form of a lot of low-risk loans. They're going to make a big chunk of cash from this sale, and then now they have more cash to loan out to more new borrowers. And it's just a constant cycle, right? Buying and selling these loans so that they can make new loans and get more what? Interest. It's all about getting that interest. If they can increase the number of people paying them interest payments, that makes everybody more profit, all those lenders. And so that's what this secondary mortgage market is all about. How is money regulated in America? We have the Federal Reserve System. Federal Reserve, we're not getting too deep in this, but you probably have heard about it. You probably heard today that they lowered a rate today, and it's probably going to translate down to interest rates for houses getting lowered, possibly. But the Federal Reserve System is in place to regulate the flow of money. It's there to kind of manipulate the interest rate. Why would they want to do that? To make it to ultimately, hopefully, serve the health, financial health of the country. But that, everybody has different opinions about that, because the Federal Reserve is also somewhat political in that a couple of years ago, President Biden had the opportunity to appoint the new chairman of the Federal Reserve. He chose to stick with the existing one. He was thinking about maybe handing it off to someone else. But that in and of itself would sort of be affected by his chosen policies, his chosen leanings. But the chairman of the Federal Reserve is the one who makes the announcement, and the Federal Reserve System is an accumulation of multiple 12 banks across the whole country, and that's the bank that's loaning the money to your bank. They're loaning money to your bank at a certain interest rate, and then your bank is loaning the money to you at a higher than that interest rate. They're making a little profit there, right? So the rate at which your bank borrows from the Federal Reserve will then be upped by some amount to make a loan on the street to each of us as we want to borrow. Federal Reserve also sets the reserve funds for banks. What's that mean? It goes back to the Great Depression. Back then, in the 30s, 20s, and 30s, banks realized, wait a minute, if all these hard-working people bring us and deposit their money to us, they usually leave a good chunk of it here. They might need to pay some bills, but there's a lot of it just sitting here. And it sure is a shame for that money to be sitting here, not accomplishing anything except just sitting here. Let's loan it out to other people who want loans, and we can charge those people interest on the money that we're loaning to them. And so the banks got greedy and loaned all of the money they had in the bank, or a vast majority of it, to people who wanted to borrow money, thinking, what could possibly go wrong? What are the odds that everybody with money in our bank are going to come here asking for their money immediately? But that's what happened in the Great Depression. They needed it. They had trouble. They had a huge problem. People had to pay bills, and they all came to the bank at once and said, we want our money. And the bank is like, well, I don't have it. I loaned it out to your neighbor times a million. And so it was realized this is a terrible idea. People, thank you, Deborah, people made a run on the bank. A lot of people said to the bank, get like in, what is it? What's the Christmas movie? Jimmy Stewart. My wife has to watch it every year. I mean, we get to watch it every year. There's a little bit of that going on in that movie. So they said, we need to require that the banks don't get to just loan out every single penny. They have to keep a certain amount in reserve so as to stay healthy. In case a lot of people wanted to pull out their money, there would be money to pull out. Can't just let it be no money in there. And all of it is for the purpose of creating a favorable economic climate, keeping things healthy. Everybody's got opinions as to how well the Federal Reserve System is doing or not. But that's sort of the overarching mechanics that's happening there. So the primary mortgage market is when a borrower is borrowing the money one-on-one, making an individual single loan. The secondary market is when those are packaged up and then bought and sold in big bundles. So who gives money to be borrowed? Where is this money that's being loaned out coming from? It's coming from insurance companies. You ever wonder where those premiums, those outrageous premiums you have to pay, what are they going toward? The private jet of the CEO? They're being invested in hopefully rather safe investments. And the real estate market is, as we learned in 2008, not 100% safe, but one of the more stable, safer places to invest money. So big chunks of money from insurance policies, premiums, is invested in the mortgage market and used to make home loans. Because the idea is most people are going to pay their mortgage if they can at the expense of maybe elaborate trips to Las Vegas and other things. They're going to make their basic payments first. We learned that sometimes that isn't the case back in 2008, but for the most part, real estate's pretty stable. Endowment funds, mortgage banks, credit unions, pension funds like the policeman's pension fund, New York cops, New York NYPD might have a pension fund, and all the money going in from all those police officers into a big chunk that's being invested in places to earn interest so that those pensioners can have money when they retire, right? And it's being put to use instead of just being buried or put in a bank, or being buried in a jar in a vault. All these are or investment groups. They will invest their money in mortgages because they know they're going to get a certain return, rather safe amount of return. That's the primary mortgage market, money being lent directly to consumers. When those loans are lumped in together, they are bought and sold on this secondary market. And so it's for the purpose of making a profit on those chunks of loans, so that the bank who sells them off and makes the profit now has more money to make new loans with, on and on and on. Just like if you got into property ownership, investing property, you might start with a duplex where you live in one side and someone else lives in the other, and you get rent from them. And then later you upgrade to maybe a single family home, and then maybe another one, and then maybe 4 single family homes, and then maybe a little apartment building, then maybe a bigger apartment. You're growing it because you make profits from the income and you're adding more investment properties to it. Same kind of thing here, right? They're making more loans along the way. So the marketplace through which these loans get bought and sold are 3. The most common, the oldest one is Fannie Mae. That's the acronym, the little cutesy way of spelling out and saying out phonetically the acronym of Federal National Mortgage Association. FNMA stands for, also known as Fannie Mae. And that's the oldest one. It's the largest one. It purchases conventional loans. FHA and VA loans are also purchased, bought, and sold through Fannie Mae as a marketplace. It's the oldest and largest one. Fannie Mae is really important because it's so popular. It's so well trafficked that it actually helps formulate government housing policies. Because of Fannie Mae's influence and the buying and selling, it says let's have these policies in place when it comes to government housing. It also establishes underwriting guidelines. Underwriting guidelines means the rules and the requirements that a lender has so that you can borrow money. They don't let you just come in off the street and borrow $100,000. They want to see your pay stubs. They want to see your bank statements. They want to see your credit score and your credit history, right? They have certain minimum requirements, and that is what the underwriter of the loan company is looking at to decide if they're going to say yes or no to loaning you the money. The underwriter is the final say, the final person involved who says, yeah, okay, all the stuff's in order. They provided everything we asked. See their tax returns. I see their income. Credit's good. Yeah, they can have the loan. The underwriter is the one who either approves or does not approve it. And so they have certain guidelines based on the kind of loan it is. And so those guidelines are established through Fannie Mae. Another mortgage market is called Ginnie Mae, and another one is Freddie Mac, but we're going to get to that tomorrow night. We're going to finish up 14 tomorrow and go on into 21. If you do see something in your quarter term exam question any point through the rest of the time, tomorrow night or whenever, let me know, and we'll get to the bottom of it. As far as the midterm, you're free to take that anytime by next week. If you want to have time for tomorrow, that's fine, but you might, how about just, let's say, have it done by next Wednesday. Go ahead and take that midterm. Somebody asked me if it could be open book or closed book. It's not going to do you much good, open book. I have no way of knowing. It's just going to help you more if you make it more similar to the actual exam in the class. So I would just give it your best shot without looking, because also that it's timed and you'd probably run out of time if you tried to look up too many answers. So just give it a shot, see where you stand, and I'm going to go over the questions from it. I'm not going to go over every single one, but again, As you're going through it, if one of them particularly bothers you more than others and you're just super confused, jot it down. Jot down the number of it. Let me know, and we'll spend time on it. So for tomorrow, again, going to finish finance and get on into 21, closing math, and closing procedures. So let me know if you have any questions, and have a great 20 some hours till I see you again. Take care.